Hi, this is Shubhankar Chakrabarti from American Academy of Financial Management. Now, today's query is how understanding systematic risk helps investors in portfolio diversification and risk management. Now, first, let us understand what is systematic risk. Now, risk has got, there are two kinds of risk. We know one is systematic, the other one is unsystematic. Systematic risk is the risk which is affecting the entire market or an entire industry or an entire country, the market within an entire country and stuff. So we'll take an example. So the recent example that we can take is COVID. So during COVID, the entire market across the globe got affected. Now, these are systematic risk. Global financial crisis, systematic risk. Banking crisis, systematic risk again, where banking as an industry gets affected. So these are systematic risks where we also call it as market risk, which cannot be mitigated through diversification. So you cannot really invest in multiple stocks to avoid systematic risk, right? So how do we mitigate this risk, or how do we ride through this systematic risk? Now, there are 5 ways we can do it. One is diversification. Now, by diversification, I mean diversifying yourself into multiple asset classes. Now, that will help you to ride through the systematic risk. So, your investment should be across all the asset classes. So that way you can avoid or you can mitigate systematic risk. And that is what asset allocation is all about. So based on your risk appetite, based on your financial plan, you would be allocating your asset into multiple asset categories. So you can put it in gold, in real estate, in debt, in equity, and that way you can avoid the systematic risk. The third is risk management. Now, when it comes to risk management, how do you do that? You can hedge. You can use hedging tools such as options. You are, let's say, investing in equity, in a direct, long only equity strategy, and then to hedge that, you are, short selling the index. So that way you can create a hedge position, and that can help you to ride through a systematic risk. If you look at investment over a long time horizon or a long time perspective, then that is another way you can avoid systematic risk. So in between, if there is a volatility, if market goes through a turmoil, you will not be reacting to it. So that way you can avoid systematic risk. And performance evaluation can be another way of avoiding systematic risk, and that can give you an understanding of what systematic risk is and how to avoid it or how to ride through it. So performance evaluation, by that, and what I mean is you can evaluate what is the beta or the volatility of your investment against the volatility of market, and what is the return that is getting generated by investing in that asset class or investing in that in that particular investment tool against investing in the benchmark. So that performance evaluation also gives you an understanding that what is systematic risk and to what extent you need to diversify your investment across all asset classes to avoid it. Thank you. I hope I answered this question.